Hi, it's Mike McCarthy, the Insurance Advisor. In this video, I'm talking about trauma insurance. So what is it and how does it work? Well, in short, if you're diagnosed with something nasty that's specified in your policy wording, then after 14 days, if you're still alive, you can lodge a claim for a lump sum that is agreed when you take out the policy. What makes this type of insurance different when you compare it to other insurances in the marketplace? And why is it important to actually have it in your insurance portfolio? A couple of reasons. A, it's structured to pay out when a serious illness is in play, and it pays out a lump sum. B, you only need to wait 14 days to make a claim. C, also, you can actually link it to a life insurance policy to make it a little bit cheaper. The most common trauma claims relate to cancer, then heart conditions, heart attacks, then neurological conditions like stroke. Whatever you do, understand that there are so many different types of trauma policies available, all of which perform quite differently at claim time. So that's where it's really important to get the best policy wording for your life stage and age. So whatever you do, choose very carefully with your advisor. What I'm going to do now is I'm just going to cover off some examples of types of trauma policies that are available in the marketplace. So first up is standard lump sum trauma. This pays out a lump sum to the amount that you are insured for. It really is as simple as that. This type of trauma is probably the most common amongst all the main insurers, largely because it's been around the longest, and it typically covers up to 50 serious illness conditions. Be aware, however, that there are some cheaper policies, and they're generally cheap for a reason, and that's because they probably cover you for a lot less conditions. That's why they're usually cheaper. Moderate, severe, or major trauma. This type of cover is similar to the lump sum trauma. However, the key difference is that these policies tend to pay out at a higher threshold than standard trauma. This involves less risk for the insurer, and for that reason, the cover is cheaper for you. Severity-based trauma. This pays out a percentage of the amount that you're insured for, based on the severity of the illness. As the severity increases, in theory, you can claim more. Another type of trauma is trauma multi or multi-trauma. This pays out 20% of the sum insured, but you can claim 5 times. Continuous trauma, that can pay out 3 times with no stand-down periods in between the payments, providing the claims are not linked. Cancer cover pays out in lump sum if you're diagnosed with cancer only. So that's one of the 50 conditions. So when you look at the marketplace, there are indeed a lot of types of trauma policies available. So whatever you do, make sure you get the best advice for the trauma product that suits you best. Now let's talk about something that I'm really interested in, and that is policy wording. Now, if you're like most of my clients, the last thing you want to be doing is reading through insurance policy wording. So let me give you an example where only a few words in a policy can make a huge difference. Let's take the stroke definition. Now, for some policies, it states that to claim on a stroke, there must be evidence of a stroke on neuroimaging, like a CT or an MRI scan. Whereas there are some policies that state if there are no evidence on neuroimaging, that then other investigations can be considered. Now, these words may seem quite insignificant, but believe me, at claim time, these words can make a huge difference between whether you get paid or not. So, yeah. Okay, other features to look out for when purchasing trauma insurance. Let's crack into it. Early or partial trauma benefits. These can be built into your policy or be added as additional benefits to your policy. Early or partial payments allow you to receive a smaller percentage of the amount insured if the diagnosis does not meet the threshold of a full payment. Some cheaper insurance policies or some cheaper trauma policies often have very limited provisions for early or partial benefit payments. Standalone or accelerated trauma policies. A standalone trauma policy is simply a policy which stands on its own. So any claim does not affect any other policy you may have. Whereas a linked, or we call it accelerated policy, is basically a life and a trauma policy combined into one. See here, you can see that both the life and the trauma policies are linked. So if you have a claim, a trauma claim, then the amount claimed will reduce your life insurance that you have. Linking or accelerating a trauma policy to a life policy does actually reduce the cost of your trauma cover, but make sure you discuss the implications of this with an advisor. So if you've got a standalone trauma policy at the moment, one way of managing the cost is to actually link or accelerate them together. Once again, get some advice on this before you do that. Another benefit is reinstatement or buyback. This is more common with the standard lump sum trauma policies. If you've already made a claim on your trauma policy and you have this feature, then after 12 months you have a window where you can apply to have your trauma policy reinstated. You won't be able to claim on what you previously claimed on, but you get your trauma policy back. Also, if you have life buyback, you can also have that life reinstated. So there is more to trauma than meets the eye. Just understand that there are so many options across the insurance marketplace. Make sure that you have the right type of trauma for your needs. So whatever you do, get advice from an insurance advisor like me. If you want to get in touch, just check out my Calendly link, which is in the description of this video. Within my Calendly link, you can book a time for a chat or set up an online meeting, or just simply visit my website, theinsuranceadvisor.co.nz, and hit the Inquire Now button. Either way, feel free to like and subscribe if you would like some more exciting, amazingly interesting insurance tips like this in the future. Bye for now.